Good evening and welcome to this third edition of series on tax audit. As you are aware, Tax Audit Quality Review Board has been constituted at the Institute of Chartered Accountants of India to review the tax audit reports which are submitted by chartered accountants to various corporates, and whatever errors, mistakes are there, they are tried to be ascertained. This is with a view to improve the quality of tax audit across the board. Tax Audit Quality Review Board is also coming out with publication, and today we have with us Chairman of Tax Audit Quality Review Board, CA Dr. Raj Chawla ji. So he will brief about this publication in his opening remarks. This is also with a view to improve the quality of tax audit. And quickly, if you want to refer something at the 11th hour or maybe for the purpose of planning, the publication will assist you. Further, in order to resolve the issues that may arise while conducting tax audit, there needs to be some handholding, some agency discussing those issues. So this series we have planned from 15 July till end of September, and on each Friday, whether you receive the intimation or you do not receive, because we will certainly send intimation to all, but maybe it has escaped your attention. In that case, you put on this particular link so that you will be able to listen discourse by eminent experts. Like today we have one expert. He will be introduced soon by Honorable Chairman. Secondly, maybe today also you might have received or encountered certain issues or may apprehend certain issues. Those also we are requesting you mail us at taqrb@icai.in. Let me once again repeat, taqrb@icai.in. We have already received number of queries, and in this series we will adequately deal with all the queries so that everybody who has raised the query, he will receive response from the eminent speakers whom we are inviting for the purpose of delivering lectures. So with these words, I welcome you at this edition of our program by TAQRB on tax audit. And I request Honorable Chairman, CA Dr. Raj Chawla, to offer his opening remarks.
Thank you, CA Chandrasekhar Chitreji, my chairman in Direct Tax Committee last year and my mentor. So good evening, friends. First of all, I welcome you all and special welcome to CA Satish Agarwal ji, our today speaker. He is a vast experience of more than 40 years in the field of taxation and litigation and advisory. Mr. Satish Agarwal has been a regular speaker at various seminars organized by the ICI and industry. He has been a convener of a study group on FEMA and NRI related issue of NIRC. He is member of research committee of Institute for the financial year 2008-9. He has been represented diverse client on complex issues before the tax authority till ITAT level regularly, and number of fellow professionals seek the firm's service for tax related matters. He has been especially invited to the Direct Tax Committee of the ICI. As a professional, he has serviced large corporation and multiple industries comprising both national and multinational in the field of taxation, including international taxation, transfer pricing, and corporate structuring. And friends, on the eve of this our CA Day, I congratulate all of you on this CA Day in advance. And today, our Honorable President of ICI has launched our CA logo. And tomorrow, we are celebrating our CA Day because tomorrow we are entering into 75th year of our existence. and Honorable President of India. She's gracing the occasion. You all are welcome there at Sri Fort Auditorium, New Delhi. So I invite all of you and friends tomorrow in the August presence of Honorable President of India. We are going to launch our publication on this tax audit quality, which is on the basis of feedbacks, suggestions by our reviewers, and the name is Quick Reference for Tax Audit under Section 44 AB of the Income Tax Act 1961. So with this, I am once again thankful to all of you for joining this program, and special thanks to CA Satish Agarwal ji for giving his precious time to enlighten on the topic of our tax audit documentation. So thank you, friends. Now over to Chitra sir.
Thank you, Satish Agarwal ji. This virtual seminars are of convenience. We are sitting at your office. We have come from council meeting, and audience is also there. But one inconvenience is that we cannot offer you a cup of tea or a memento. So maybe sometime we will invite you here and join us for a cup of tea. And to all my attendees, we would have been more pleased to be physically interacting. But in these given limitations, the advantages are also enormous, that you are able to have eminent faculty like Satish Agarwal discussing these issues, and from the nook and corner of the country, from the length and breadth of our India, you will be able to listen to it. So as far as this publication is concerned, quick references to tax audit, I would appeal all of you to go through this publication. In coming 2 days, we will put this publication on website of TAQRB, and you take benefit of this publication. So thank you, Satish Agarwal ji, for joining, and we look forward for your presentation.
Thank you, Raj Chawla ji and Chitali ji, Chairman and Vice Chairman of the Tax Audit Quality Control Board. And good evening, all my friends, brothers and sisters. I would like to begin with a very simple issue, that we discuss very complicated topics, but tax audit is basically the bread and butter of chartered accountants in mofussil towns, small towns, and areas where they do not have much of industries or much of manufacturing activity. The form has become quite complex because the basic objective of Form 3CD and the conduct of tax audit was to assist the tax department. When it was introduced in 1984, with effect from assessment year 1985-86, the basic aim was to give tailor-made information to the income tax department on the various provisions like disallowances for cash payment, for any excess payment above certain limits, or late payment of PF, PSI, etc., etc. I'm not going into it. And apart from the corporate entities, I'm not talking of the tiny or small corporate entities, because unfortunately in India, even if the turnover is 100 rupees or the turnover is 10 crores, most of the provisions of the corporates are different than the non-corporate entities. So, friends, the topic given to me is audit documentation. This topic is of vital importance today because the chartered accountants as professionals have to build trust in the regulatory authorities, in the assessees, and the stakeholders at large. Now, this trust deficit can be bridged by the documentation as and when called upon by the regulatory authorities or any other occasion to demonstrate that the tax audit has been conducted in accordance with the SA 230. Now, standard auditing 230 is the audit standard, audit practices which are mandatory. Now, all audit documentation I will like to take you through to all the clauses briefly and then come to that particular requirement wherever required for the documentation. Now, introduction, as I have already given, that the tax audit today is applicable in a normal case where the turnover of an assessee doing business. Now, the first thing is the assessee should be engaged in business. Wherever its turnover is more than 1 crore, the tax audit is applicable under section 44AB with certain exceptions that if the cash receipts are less than 5%, then the limit is 10 crores with a view to promote digital transactions. Similarly, certain exceptions have been carved out for presumptive tax under section 44 AD and ADA, which is not the subject of this topic, but incidentally, this is what I would like to present before the audience. And the tax audit for corporate assessees or those which are subject to audit under any other statute, the requirements are slightly different from those which are not subject to any audit under any other law. That means they are only subject to audit under the Income Tax Act under section 44AB. The requirement under section 44AB for those entities from the auditor which are not subject to audit by any other statute is presentation of true and fair view and correctness of the accounts and the particulars as per the Form 3CD. And as far as conduct of audit of any other entity, notably corporates, is concerned, which are subject to audit under Companies Act or any other act, the requirement of true and fair of the accounts is not there in SA 230. The tax auditor can just annex the audited profit and loss account and balance sheet, and he has to ensure the correctness of the particulars of Form 3CD. Now, there is a conflict between the standardized online utility and the SA 230. There is no scope in the standardized utility for the auditor to present his views or to give a paragraph, responsibility paragraph of the auditee. The basic thing is that Form 3CA is required to be used for the tax audit report in case of assessees who are subject to audit under any other law. And 3CB is required to be used for those entities which are not subject to audit under any other statute. Here, I may mention that since the charitable trusts are not engaged in any activity of business or profession, they are not subject to tax audit. So any entity which is not engaged in carrying on a business, the section 44AB begins with any person or any concern engaged in business or profession, and then clauses A, B, C, etc. are applicable. The tax audit is also applicable where the profit is less than the presumptive tax of 8% or 50% as per section 44AD and 44ADA, applicable for businesses and profession respectively. Now, instead of going theoretically into audit documentation, I would take you to each and every clause and, to the extent feasible, try to elaborate on the documentation that is required to be maintained and obtained by the tax auditor. The first clause is clause number 1, which is name of the assessee. The name of the assessee is supposed to be in conformity with the name mentioned in the PAN number. And in case there is no PAN number, then with the Aadhaar card. So therefore, the tax auditor must obtain a copy of the PAN card or Aadhaar card. So this is one documentation which will satisfy the requirement of the correctness of the name which is mentioned in the tax audit report for which the audit is conducted. Here I would like to clarify one more thing. In a proprietor, he may be having more than one firm, 2 firms or 3 firms. Then the audit is being conducted for an assessee, which is an individual. So his 3 firms or 2 firms or more than one firm are to be treated as a single entity for the purpose of computing the turnover and conduct of tax audit. He may have different balance sheets, different profit and loss account from different verticals or different firms, but all these have to be combined. Then the tax auditor has to mention the address in the tax audit report, and in case there are branches, then the address of the branches has to be mentioned. The tax auditor, if the business of the assessee is subject to GST or any other regulation, can obtain the confirmation from those sources independently, as also obtain a list from the assessee of the addresses and the branches he maintains. Then clause number 3 is the permanent account number. Now this is already I have covered in clause number 1 with the name, that the name should correspond to the PAN name. But here I can tell you one more thing, that it has been observed that there are more than one PAN in some cases. There is duplication, though by and large duplicate PANs have been cancelled, but there still may be cases because some time ago there was a multiplicity of the PAN allotted. So in those cases, the PAN number that is used for filing the tax return and is in use only has to be mentioned. Then clause number 4 is regarding the registrations under the indirect taxes. Now, indirect taxes are not defined, but they encompass all indirect taxes other than direct taxes. Many of these have been subsumed in GST, but certain items like liquor are still subject to VAT, are still subject to state excise duty, etc. And the auditee must be asked to furnish a list of its registrations for all branches and under all different indirect taxes, including import-export code number, and the independent verification by the SSC, by the tax auditor can be done by obtaining the password of the GST and other statutes, because as on date, most of the registrations, etc., are PAN based, including under customs, and are accessible online. So, this is with respect to indirect taxes. But as per the guidance note, there is one guideline for the tax auditor, which is that in case the tax auditor is of a prima facie opinion that any indirect tax is applicable for which registration has not been obtained, he is expected to report that in the tax audit report. Now, there is no column, as I said, in the utility, so that as per the SA 230, the tax auditor is required to state in para 3 of form 3CA or para 5 or 3CB, in which he also is required to give the responsibility paragraph. So, friends, my purpose of going through each clause was to identify, to the extent possible, except in very few cases, the documentation that is required. So, in this process, the documentation would be collected by the tax auditor. Now, clause 5 is to mention the status of the SSC, which is covered by section 2, subsection 31 of the Income Tax Act, which states the person includes person as an individual, Hindu under family, body of individuals, association of persons, etc. Now, the partnership firm will also include limited liability partnership, irrespective of the fact that limited liability partnership has to get its accounts audited under the Limited Liability Partnership Act, and also it has to file its financial statement on the portal of the registrar of companies. Irrespective of that, it is to be treated as a partnership firm. The status aspect is also taken care of, which can be verified from a copy of the Memorandum of Association, partnership deed, supplementary partnership deed, change, which will come to a little bit later, where the requirement for profit sharing ratio, etc., of a partnership firm is required to be stated. Now, clause 6. The first 8 clauses are informative and very simple, so I'm going through quite fast on them. Clause 6 requires the mention of previous year. As we are all aware, the previous year is uniform from 1st April to 31st March. However, for any new business, for any business on account of demerger, merger, etc., or reorganization, the previous year will start from the date of that start of business or the demerger, etc., and will end on 31st March. So, as far as previous year is concerned, this is all, and the tax auditor must obtain the evidence for any change in the organization due to amalgamation, etc., and obtain a copy of the amalgamation order, etc. Assessment year is simple, again uniform depending upon the previous year. Clause number 8 is important since it is required to mention that the audit is being conducted under which clause. Clause A of 44AB requires the conduct of audit of a business entity where the turnover is 1 crore. In case it is receipts are less than 5% in cash, then 10 crores. So, if the limit is exceeded in both cases, then the relevant clause is clause 44AB, clause A. Similarly, for profession, the limit is 50 lakhs. It has been, I will come to the different limit for presumptive tax, but as far as tax audit is concerned, it is 50 lakh. And for the financial year 23-24, assessment year 24-25, the limit has been increased to 75 lakh. Now, clause C is for those where the presumptive tax is applicable under section 44AE, 44BB, etc., etc. Clause 44D is where the profits of a profession which are notified, those are less than the 50% of the gross receipts. Now, those gross receipts are computed as per the accounting norms. As far as turnover is concerned, in the case of a business, I would just like to point out, in the case of derivative transactions, the difference of losses and profits are to be aggregated. That constitutes the turnover because the turnover is not defined in the Act. It is as per the guidance notes. Clause 44ABE is for businesses where the profit is less than 8% and they are below the threshold limit of 1 crore or 10 crore. Now, clause 8A, this is important for a tax auditor. The government has come out with various schemes like concessional 15% for corporate assessees under section 115BAB, which are set up after October 19, engaged in manufacture of certain items, and then as per 115BA, then 115BAC, BAD, etc. Now for these, forms are required to be filled. 10 ID, 10 IC, 10 ID, 10 I, etc. Now, whichever form is applicable, that is required to be filled, and only then the assessee can be said to have opted for that scheme. Since there is likely to be a gap between the filing of the return of income and the conduct of tax audit, since the due date for filing the audit cases return is 31st October, and for the conduct of audit is 30th September. So in some cases where in previous year the SSC has not opted for the scheme as per the Act under 115 BA, BB, etc., then a representation should be obtained from the SSC that it is going to opt for a particular scheme. Now, that particular scheme may change at the time of filing the return of income, but then the form which is filled up by the auditor is as on the date of conduct of audit, and the auditor has obtained a representation. So this audit documentation is very necessary to ensure that in such cases where in previous year no such scheme has been opted, the representation is in the audit documentation file. Now, friends, incidentally, this is again applicable from next financial year. For individuals, the old scheme, for opting the old scheme, one has to file a form which will be prescribed, and the new scheme is the default scheme, meaning thereby that will be automatically treated as the option of the assessee. That, of course, is applicable from next assessment year. Now, clause 9A is again informative, very simple. One has to mention the name of the partners, members of any AOP, and their profit sharing ratio. And if there is any change in the partners or members or in profit sharing ratio, since the last date of the preceding year, the particulars of such change. It is quite simple that all this information can be found from the copy of the partnership deed, copy of supplementary partnership deed. In the case of LLP, from the copy of registered memorandum agreement of partnership, and the record from ROC for any amendment in the partnership agreement, and in the case of AOP, on the basis of document of the AOP. And in some cases, it is possible that the share of members of the AOP may not be determinate. There are certain discretionary trusts which may be conducting business on which the provisions of tax audit may be applicable. Now, those also have to be mentioned that the shares as on the date were indeterminate. Similarly, the change in the ratio as compared to the preceding last year also can be culled out from the copy of the partnership deed, supplementary partnership deed, or the memorandum partnership agreement on the ROC website, etc. Now, clause 10A. This is again informative and quite simple. Nature of business or profession has to be indicated, and if there is more than one business or profession, nature of every business or profession. Similarly, in 10B, if there is any change in the nature of business or profession during the particular year, then that has to be mentioned. Now, as far as corporates are concerned, the change in nature of business may be evident from the study of minutes book of the board of directors or the copy of the amended objects clause. However, in many cases, the object clause is not amended or is not required to be amended. So in such cases, a representation ought to be obtained from the auditee that there is no change in the business line as compared to last year. Now it has been noticed by the Tax Audit Quality Control Board that the code number mentioned for the various lines of business has not been found to be correct. Since the data is collated on the basis of code number and not on the basis of description of the business, the code number which is correct only should be mentioned. Now, clause 10b, which requires the change in nature of business, is required to be also stated in the 3CD form. Now, change in the nature of business is to be understood correctly. The change in nature of business broadly could be from manufacturing to job work. If an SSE was engaged in manufacture on a principal basis, but due to corona or some other incident during the previous year, he has decided to do the job work on the same plant and machinery, then this qualifies as a change of booking, a change of business. Secondly, in case he was engaged in the business of electronics or manufacture of automobile spare parts, but instead of manufacturing a particular type of electronic part or a particular type of automobile spare part, he manufactures a different spare part or automobile spare part, then that is not a change of business because the broad classification of electronics remains the same. So there is only interchange of item, but it is not the change of business. So all this can be found out from the record perusal of the profit and loss account and the vouchers, sale purchase invoices, etc. Now that is part of the audit documentation that the evidence has to be brought in the audit documentation of the change of business. And for that, whatever documentation is relevant for a particular business may be brought on file. Now, clause 11A requires the tax auditor, first of all, to state if any books of account have been prescribed under section 44AA. Then the list of books so prescribed. Till date, books of account have been prescribed only for the specified professions. Medical, engineering, accountancy, all those specified professions. But no books of account have been prescribed for entities conducting business other than those specified professions. So in this clause, if the auditee is other than under those professions, then the answer has to be no. Otherwise, if it is covered by those professions, only then yes has to be stated. Then the next point is list of books of account and relevant documents examined. Now, most of the cases, the Quality Control Board has found that only books of account, cash book, ledger, etc. are mentioned, whereas the vouchers, agreements, TDS returns, GST returns, etc. are not mentioned, which are required to be mentioned. Now, The next is the issue of books of account were kept. Now, as far as the Companies Act is concerned, the books of account are required to be normally kept at the registered office. In case they are kept at any other place, a required form is to be filed with the registrar of companies to indicate that the books of account are kept at a different place other than the registered office. Now that documentation is required to be obtained by the tax auditor in his audit record in case the books of account are kept at a different place other than the registered office. Now, as far as the non-corporate assessees are concerned, if the books of account are kept at the place at which the address is stated in the first or second clause, then a representation should be obtained from the auditee that the books of account have been maintained at the address as per the PAN particulars or a different address to ensure that these are correctly reported in this clause. Then the question of computerized books of account. Now, mostly the books of account are computerized. Now, the location of the computerized books of account is governed by the IP address, meaning where the server of the assessee is located on which the books of account are maintained. So that also must be obtained from the assessee and maintained in the audit record. Now, clause number 12. This is just informative. Mostly it is inapplicable. Now, this is in case where an assessee is having more than one business, and in one business he is availing the presumptive tax under 44AD, 44AF, AF, etc. And another business for which the tax audit is applicable. And in such cases, the simple requirement is that the auditor has to specify as to what is the profit or loss of that particular business under section 44AD and all the other businesses, 44BB, etc. The tax auditor is not required to comment on the adequacy or inadequacy of the profits computed under those sections. Whether it is in compliance with that section or not is not relevant. What is relevant is what is the amount of profit that is included in the tax audited profit and loss account. That only has to be mentioned. Now, clause number 13 is quite important. That is method of accounting employed in a previous year. As far as corporate assessees are concerned, the Companies Act provides that they are required to maintain books of account only on mercantile basis. They are not allowed to maintain books of account as per the Companies Act on cash basis. So therefore, as far as corporate assessees are concerned, the method of accounting would invariably be mercantile. As far as other than corporates are concerned, the method can be cash or mercantile. Mixed method is no longer recognized by the Income Tax Act. So in the case of any change in the method employed, it has to be intimated along with the effect of change in method. Now, there is a fine distinction between change in method and change in accounting policy. The change in method is different from change in accounting policy. An assessee may change the accounting policy of rewarding its employees after 31st March or making some discount adjustment for the dealers after 31st March. Now, that is a change in accounting policy. That is not a change in the account method of accounting. Friends, just give me a second. I'll just have a glass of water. Now, clause number 14. And also, I forgot that in clause 13D, the government had made an amendment in the Act to prescribe income computation and disclosure standards without requiring the assessee to incorporate those changes in the books of accounts. For example, there are certain issues which, in spite of being part of the mercantile system of accounting, are required to be adjusted for computation of income, like effect of foreign exchange, changes in the cost of fixed assets, etc., or in the accounting of income of derivatives, etc., accounting of income of contracts, etc. That's a separate topic. So therefore, I'm not taking that. Now, in clause 13D, one has to clarify that when any adjustment is required, and if required, then yes has to be stated, and then in the drop-down facility of the form 3CD, it has to be uplinked what is the adjustments. And such adjustments are to be reported in clause 13E. Now, clause number 15. This is again quite simple. Conversion of capital asset into stock in trade. Friends, I would just like to remind you that an amendment was made about, I think, 4 years ago to tax the amount of difference between the cost of capital asset and the cost at that particular date when the stock is converted to tax, irrespective whether the asset which is converted, which is mostly land or building, is realized or not. Now, this is important. Apart from the particulars that have to be given, description of capital asset, date of acquisition, cost of acquisition, and the amount at which the asset is converted into stock in trade. Now, for this, what is important is that the tax auditor has to obtain the cost record in the form of registration copy in the case of land or building, and also for valuation, for conversion of stock in trade, if the circle rate is available for that land and building, that would suffice. But if no circle rate is available, then probably a approved valuer valuation report, which is backed with requisite evidence, credible evidence of similar such cases, properties being registered or nearby proximate areas, that has to be obtained by the tax auditor to ensure that the price at which it is converted is the fair market value as on that date, and a declaration should be obtained from the auditee of conversion from capital asset to stock interest. Now, clause number 16 requires the auditor to mention the items as per section 28 subsection 4 which are required to be reported in the amounts not credited to profit and loss account. For example, there could be an amount as per recent amendment of section 194R, where any haircut obtained by an assessee while finalization of its loan obligations to a bank, whether towards capital or towards interest, is to be treated as income. That amendment is, of course, effective from next year. There could be certain other such items, and then a item which is required is escalation claims accepted during the year. For that, the examination of the accounting record has to be done on the basis of contract, on the basis of the clauses of the contract, if any escalation is applicable, and if it is applicable and whether it has been obtained during this year or agreed to by the contractee if the assessee is a contractor. Now, all this is part of the regular audit, and the onerous duty of the tax auditor in the case of non-corporate assessees is much more than in the case of corporate assessees, because in the case of corporate assessees, the tax auditor can rely on the statutory auditor for such information, but otherwise he has to obtain a representation from the auditee. Now, an interesting issue in this is that the clause also requires to mention whether any capital receipt is there which is not credited. Now, it is a question which is very difficult to answer, whether this is a capital receipt or a revenue receipt. Sometimes the auditee may treat it to be a capital receipt, whereas the auditor, based on his understanding or based on the authentic case laws of the Supreme Court or other jurisdictional court, may believe these to be a revenue receipt or vice versa. In these cases, the guidance note prescribes that the view of the auditor and of the auditee both must be stated in the relevant para 3 or 5 of Form 3C A or 3C. So this is as per as Form 16. I could only say that the tax department envisages a virtual assessment to be done on behalf of the government or the income tax department by the tax auditor, in spite of which they do not, in many cases or most of the cases, accept the tax audit report as correct. In clause number 17, that again is informative, whether any land or building is transferred during the previous year for a consideration which is less than as per section 43C A or 50C. Section 43CA is for business transactions and 50C is for capital assets. When any land and building is transferred as business asset, Section 43CA is applicable on that business entity. And when any capital asset is transferred, then the clause 50C is applicable. Now, what does these two clauses say? These two clauses simply say that in case of the sale consideration realized and credited in the profit and loss account being less than the circle rate prescribed for those properties, then the auditor must report here. However, in case there is no difference, then it has to be stated as nil. Now, for that, the auditor must obtain copies of the registration deed, keep that as audit documentation to verify that the sales realized on sale of land and building, whether subject to 43CA for a business asset or 50C for a capital asset, is not less than the prescribed circle rate, or if it is as per the circle rate. Now, the next question, which is of a far more importance and sometimes difficult, is where the property is not registered, where the beneficial ownership is transferred under Section 247 and Section 247 of the Income Tax Act recognizes that as a transfer. The provisions of Transfer of Property Act are different. The provisions of Section 2, subsection 47 are different as far as the question of transfer is concerned. As per Section 2, subsection 47, the Income Tax Act does not require the registration of land or building necessarily to tax it as income under the head business or capital gains. In such cases, a valuation report ought to be obtained of the property transferred, and then the auditor ought to give his comments to be on the safer side. But where the property is adjacent or of the area where the circle rate has been prescribed, then he should not have any problem and get a circle rate of that property from the SSC and independently verify that and keep it in the documentation, which would suffice to comply with the audit requirements of this clause. The basic aim of this lecture and the basic aim of Essay 230 is to demonstrate, if and when required, that the tax auditor had made appropriate checking of the required documents and legal provisions while confirming the correctness of the particulars of various items required to be stated in clauses 1 to 44 of the tax audit form 3CD. Friends, I have not touched upon any of the case laws where I can touch at any point of time whenever you would like to. I have kept myself limited to the scope to the extent feasible, and at the time of question answer, if required, I will try to take up those issues which are controversial. Right now, I am restricting to the basics because, as I said in the beginning, this topic is meant for the whole country, where the tax audit is the main source of income of the chartered accountant in a small town or a small city. Now, question number 18. Particulars of depreciation allowable as per the Income Tax Act in respect of each asset or block of assets. Now, this is again very simple. The tax rates are prescribed and the eligibility of depreciation is on the basis of whether the asset is owned for less than or more than 6 months. If it is less than 6 months, then half the depreciation prescribed is allowed. And if it is more than 6 months, then the prescribed full depreciation is allowed, apart from the additional depreciation on the basis of new addition of plant and machinery in a particular year. Now, all this I am not commenting in detail because this is a regular routine, and normally the simple requirement in such cases is to obtain the copies of the purchase invoices of fixed assets, and then in case any machinery etc. is fabricated in-house and used by the auditee, then in such cases a certificate from a chartered engineer could be obtained to ensure that the date of start or functioning of that machinery is correct, or a representation from the technical team, if it is an assessee of that stature and that turnover can be obtained, that this is the date on which the particular machine was commissioned. And I'm talking of a big machine, I'm not talking of something. For example, what happens that a CNC machine or any big machine that cannot function without computer installation or without particular motor. So what happens in certain cases, the expenditure of computer is for less than 6 months, date of purchase is later, and the machine is purchased, bare machine is purchased before 6 months. That is why the clause is date of purchase and date of put to use. Now the depreciation is eligible from the date of put to use. Now in such cases, the date of put to use will be determined on the basis that the machine is capable of working on that particular date. So that would be the date of functioning of the machine. Now, amounts admissible, clause 19 under section 38 AC, etc. I am skipping that because most of them are not applicable. In very few cases, these are applicable because the government had made all these clauses redundant by putting sunset clauses, and since it is already past 1 hour, I am not taking more time on this since it is a matter of checking of record. Now, clause 20A, any sum paid to an employee as bonus or commission for services rendered where such sum was otherwise payable to him as profit or dividend. Section 36(1)(3), subsection clause 2, 36(1)(2). Now, friends, this is not to be confused with regular bonus or any other normal contractual liability. This is something which is as per the contract, as per the available contract or the appointment letter. If certain part of the profit or dividend is distributed on the basis of, let us say, some sort of understanding, then that has to be reported. Now, clause number B. Now, this is contribution for funds received, which has been a very controversial issue because of ESIPF of the employees' contribution. So, this basically covers the contribution of the employees towards ESI and PF. In this clause, the information has to be given of the due date as per the respective acts and the date of payment. The auditor must obtain the challans for payment to verify the date of payment and just record that. It is not the duty of the auditor to mention whether that is allowable or disallowable. That is the duty of the department, and because of the automated software, even before the delivery of the judgment of the Supreme Court in the case of checkmate, the software was so designed since last 3 to 4 years that under section 143(1), suo moto disallowance was being made of any payment of PF or ESI made beyond the respective date as per the acts, but before the due date of filing the return of income, since the thinking in the government was that this is not the intention of the legislature, which has been confirmed by the Supreme Court in its judgment in the case of checkmate, and that judgment is applicable as if that was the law itself. So therefore, this clause is only informative. Clause 21A. Now this is again something in which the auditor has to make a judgment. Expenditure of personal nature, expenditure of capital nature, expenditure incurred at clubs, etc. Now all these are matters of fact in a particular assessment. So as in a regular audit, the particulars of expenditure of clubs, etc. have to be vouched and gone through to see that any entrance fees, etc. is separated from the regular club expenses. Now, as I said, that it would be difficult to find out whether any expenditure which is debited to profit and loss account is of capital nature or revenue nature. There is a controversy on the interpretation of that because no definition can be given. All these depend upon case to case. So there are guidelines given in the tax audit guidance note, latest guidance note of 22, which can be referred to. And in case of difference of opinion between the auditee and the tax auditor, this may be mentioned in the relevant para 3 or 5 of Form 3CA and 3CB, because there is no such column in the utility. Now, 21B. Now, this is quite simple. Amounts inadmissible under 40A, that means payments made to residents and non-residents without deduction of tax at source wherever applicable. Now, there is a practical difficulty here that the amounts in many organizations may not be discernible on the vouching, etc., because of the transactions being very huge. So the guidance note permits that the tax auditor can do test check, but he must mention that in the form and obtain a representation from the auditee that he has complied with the relevant provisions of tax deduction at source wherever applicable. Now, this is in cases where the auditor is not able to find out from examination of sampling, etc. But in cases where he is able to find out the cases where applicable TDS has not been deducted, he has to report that. And that reporting is to be done as per expenditure, amount, etc. Similarly, in clause 21C, the amount of salary, interest, bonus, etc. paid to a partner is required to be stated. Now, section 40B prescribes the amount which is eligible for deduction as per the section to partners for payment of interest. Maximum rate allowed is 12%. For payment of remuneration, the slab is there, 90, 60%, etc. Now, all this is to be computed with reference to the copy of partnership deed, supplementary deed, and the eligibility, which is based on particular profit and loss account of that previous year, which is being audited. So the tax auditor has to make a working note in his audit file of the computation of eligibility as per section 40B, and then if it is beyond these provisions of section 40B, he has to certify that, report that. In case, I must share with you that there is a famous judgment of Delhi High Court, Sood Bridge and Company, in which it was mentioned that the remuneration to partners would be as per the provisions of section 40B. So that was treated as not a proper mentioning of how the payment to partners is to be made, and it is to be specifically mentioned in the partnership deed or the supplementary partnership deed. Then there are other similar disallowances, clause 21D, disallowance under 40A3. Here again, the record could be voluminous and there could be branches. The tax auditor here may also do test check and obtain a representation from the assessee that he has done, complied with the provisions of section 40A3, and the tax auditor may state that he has done his test check, and on the basis of test check, whatever his findings are, he can give that. Now, payment of gratuity not allowable, 21E. Now, this is again quite simple. Provision of gratuity is not allowable under 40A7. 21F. Now, this is sum paid by the assessee as an employer not allowable under section 40A9. Now, this is something which is again factual and has to be found out from each assessee's record. If any sum which is of that nature has been paid and is not allowable. Particulars of any liability of contingent nature. Now, as far as companies are concerned, this is quite simple. The tax auditor can rely on the statement of contingent liabilities as per the CARO, but that is not to be reported unless any contingent liability is debited in the profit and loss account. Normally, contingent liabilities are not debited in the profit and loss account. In the case of non-corporate assessees, the assessee could be asked to give a management representation letter in which this particular aspect may also be mentioned, that no contingent liability has been debited to profit and loss account. Then 21I is similar. This also is factual, that in case a loan is taken for acquisition of a capital asset and the gestation period is there between the obtaining of loan and the commissioning of the asset, then the reporting has to be done under this clause, which is similar to the concept of borrowing cost standard in the case of corporate companies. Then clause number 22, amount of interest inadmissible under section 23 of the micro, small and medium enterprises. Now there has been a emphasis on the disincentive to delay the payment to such organizations. So this clause wants the tax auditor to give the information regarding whether any interest has been paid to MSME for late payment as per the MSME Act beyond 45 days, then that has to be reported. Now, an amendment has been made in the Act effective from next year. Now, that amendment I am not going through except to state that it would become incumbent for every assessee to obtain, whether subject to tax audit or not, which is in the business of to obtain a representation or a clarification party-wise whether it is registered under MSME or not. And that even for the assessment year 23 should be obtained by the tax auditor wherever feasible, or in the absence thereof, at least obtain a representation from the auditee that in case no interest is debited, that no interest to MSME has been paid. Now, particulars of payment made to persons specified under section 48(2)(b) is again simple. This is again factual. The tax auditor has to obtain a list of the parties covered under 48(2)(b) and then report each item of expenditure. Suppose there are 7 payments, 8 payments, salary, interest, or any other payment to one person, then all these 3 payments have to be reported separately. Salary separately, interest separately, and any other payment which is to be separately reported and not clubbed. The tax auditor only has to obtain a list and then correlate the payment made to such persons and report that. Now, clause number 25, any amount of profit chargeable to tax under section 41 and computation thereof. This is again a very complicated issue for the tax auditor, since he has to make a decision as a auditor whether any trading liability, there is a remission of trading liability. So there are a number of case laws which are on the basis of facts of a particular case. There was a case of Supreme Court because the income tax department used to treat any creditor which is not paid for 3 years as remission of liability. the Supreme Court came out with a judgment that as long as the creditor is reported as a creditor by the assessee in his books of account, then that is an admission of the debt due. And the law of limitation of 3 years will not apply, and it cannot be automatically treated as remission of liability. Now, this is for the general information, but this alone is not sufficient. Facts have to be gone to each case to find out if there is remission of liability. That means no longer any liability is required, then that has to be written back. Clause 26 is 43B. I think I can skip that as well because this is again factual. Payment made toward bonus, payment made toward PF, ESI, payment made to bank interest, and so many payment made to railway. Every year, the scope of 43B is being increased. So all this is factual. This will have to be reported by the assessee to the tax auditor, and tax auditor will have to conduct the audit as per the standard auditing practices and come to conclusion and maintain a record in his audit papers that he has done appropriate checks of the relevant items to report these items. Then clause number 27A is again factual, B is also factual. Particulars of income expenditure prior period, that also is required to be given. Now, clause 28 is not applicable for assessment year 23-24. This was regarding section 56 to 7A. Now, clause number 29. This is again factual. This has to be examined. This is in respect of corporate assessees. The government has prescribed Rule 11 UA to compute the fair market value of a share, equity share, if any, issued by a corporate assessee. Now, if the corporate assessee issues any share on a price which is more than the fair market value, suppose the fair market value of a share is 50 rupees and the share is issued at 100 rupees, then 50 rupees is taxable. Under this clause, the tax auditor has to report that. This is again factual and this is applicable to corporate assessees. 29A is whether, this is again clause 9 of subsection 2 of 56, any amount which is forfeited. If you recollect earlier, the amount forfeited in the case of a capital asset was required to be deducted from the cost of asset at the time of computing the capital gains. Now, this practice was then adopted by most of the persons, and they used to decrease their actual profit, mostly the builders, by arranging their affairs in such a manner and claiming the amount forfeited as business expenditure. Now, this has been brought on the Form 3CD to give the department information. If any amount is forfeited, that has to be mentioned because it is not taxable. 29B, this is again informative. This is factual. Received in business or profession. This is again one of those whether the amount is subject to 56 to 10. So that is again factual. Then clause 30, again factual. Amount borrowed on hundi or any amount due thereon. amount clause 30A is applicable again to corporates and in the case of transfer pricing. Now, this primary adjustment itself is a separate topic. I am not taking into it. This is again factual. In case a transfer pricing audit has been conducted, primary adjustment has to be made. In case the interest paid on borrowings is more than what is prescribed in that section, what happens that most of the multinationals used to devise their businesses in India in such a way to ensure that lesser and lesser profit was retained in India and they were not required to pay tax or very little tax. So to curb that practice in case of international transactions where most of the profit was retained by the parent company outside India, apart from arm's length price, they have made an amendment that in case a certain percentage of interest is paid, keeping in view the overall profit, then primary adjustment has to be made and that has to be reported. Then next point is 30B. Now this is again similar to that, transfer pricing. This is clause 30B. Any interest expenditure incurred by way of interest exceeding 1 crore rupees. So this is again of that nature. Now section 30CA. Now this is relevant and this is applicable recently. Whether the assessee has entered into an impermissible avoidance arrangement as referred to in section 96 during the previous year. If yes, please specify. And nature of impermissible avoidance arrangement, amount in rupees of tax benefit resulting to all the parties to the arrangement. Now, this is expecting a bit too much from a tax auditor, but anyway, that is not the question. The question is this is a requirement of the Form 3CD. Now, for certain years, this clause was not applicable, and even today, this is known as anti-GAR provision. This is based on law in UK and USA, whereby in case of any arrangement which is perfectly legal, where the tax advantage, perceived tax advantage by such arrangement is more than 3 crores, then it has to be reported. I will give you the examples which normally are there and which come to our knowledge. In the case of amalgamation of a sick company where there are losses of 50 crores brought forward, it is amalgamated with a company of the group in which there are profits of 40 crores. So by amalgamation, by complying with the other requirements of section, no change of shareholding for 5 years and all those things, the point I want to make is that this provision is for such type of arrangements. And when these type of arrangements are before the NCLT, the Income Tax Department invariably makes a representation and objects to it. And then the assessee is required to justify that this is business reorganization and not an attempt to evade the or minimize the tax liability. So this is a clause which will require the assessee in some cases where the perceived tax benefit is more than 3 crores to report that. Now, clause 31A, particulars of each loan or deposit. This is 269 SS 269 SS, T, etc. I think I can take all that as read because these are all factual and there is no change except that the last 8 years have witnessed changes in the provisions regarding acceptance of cash above 20,000 in the case of advance or sale of a property with effect from 1/6/2015, which is not known to many persons. So, by reporting in these clauses, the tax auditor, in case of any real estate transaction, must obtain copies of the registration deeds wherein the purchase consideration is mentioned and the mode of purchase consideration or the sale consideration is mentioned. That is one. Similarly, an amendment was made about, I think, 3 years ago regarding the acceptance of not more than 2 lakh rupees in one sale transaction, either in the course of business or even from a person who is an individual who goes to a tent house, who goes to a banquet to incur marriage expenditure or any expenditure that is covered. So these are the broad issues which are here. This covers the clause 31 because if I go through each and every clause in detail, I want to try to go through only those clauses where information or representation other than the factual is more important. And this all is a question of fact in a particular case. And then clause number 31, I'm skipping. 32. Detail of brought forward loss or depreciation allowance. Whether a change in shareholding a company has taken place in the previous year due to which losses incurred prior to the previous year cannot be allowed to be carried forward in terms of section 79. So now all these are again applicable from case to case basis. These are to be reported where there is a brought forward loss. Now brought forward loss has to be as per the assessment order. And in case the difference is there as per the assessment order and the returned income, the reference of the assessment order has to be given in this clause. So this is mostly missing. So it is now not very difficult for the tax auditor to verify this. This is accessible from the income tax account with password of the assessee, where the tax audit report is also required to be filed by the tax auditor. So therefore, the tax auditor is supposed to have the password of the assessee from where he can verify the tax record of assessment orders and the changes, if any, in the brought forward losses, etc. This has to be reported. Then, in case of change of shareholding, again applicable to corporate assessees only, wherever there is an amalgamation, etc., reorganization of business, and as per section 79, more than 51% of the shareholding is not required to be changed within next 5 years from the date of amalgamation, etc., or where a company, a firm is converted into a company as per Schedule 9. All these things are to be reported here, that if there is a change of shareholding, which is again a factual thing, which can be verified from the website of the Registrar of Companies, and if there is a change that is reported there in the annual report. And also, in case there is no annual report, then a representation should also be obtained in case of amalgamation, etc., that there has not been any change beyond 51% as prescribed in those sections of capital gains where the exemption for conversion or amalgamation has been obtained. Now, this is with respect to this. Then again, this is clause number 32. Clause 33, detail of deduction admissible under section 10A, 10AA, etc. As I started and when I said with reference to other clause that most of the deductions have been abolished because the government has come out with certain schemes as per section 115 BAB, BA, etc., where concessional rate is offered, but the deductions have been done away with. However, for those which were eligible earlier and those are continuing in the relevant year because certain sections allow deductions for 10 years. So if those are still in vogue for those assessees, then it has to be obtained that a specific report, if the tax auditor is giving, then he has to furnish the required particulars. And if a different chartered accountant has certified the particulars of that deduction, then that has to be reported and mentioned that he is relying upon the amount deducted claimed as per the report issued by another chartered accountant. Now, clause 34A is also factual. Tax deduction account number, etc., etc. Total amount of payment or receipt or nature specified, amount of tax deducted. So this is a summary of all the various requirements in the various clauses of 34A. Here again, because of the voluminous nature, the assessee may have to rely on the representation of the assessee that the provisions have been complied with, and he can then mention that he has completed the above clause on the basis of a test check conducted by the tax auditor and has relied upon the representation of the auditee. Then 34B also wants the tax auditor to mention tax deduction and collection account number, date of furnishing of the tax audit returns, etc., 27Q and all that. That is again a collection of data, basically to launch proceedings for late filing, collection of fees, etc., from the assessee. Now, I think I missed that clause. I would like to clarify here that if any payment is made for late filing or of interest, that is not a penalty. As per the circular of the board, as also as per the Supreme Court judgments, this is a payment which is known as compensatory in nature. Penalty is which is violation of law. An amendment has already been made in the Income Tax Act last year, specifically keeping in mind the payment or the benefits given to doctors by the pharmaceutical companies, etc., to state that any payment made in violation of the rules, regulations, or the code of conduct of any organization would be treated as penalty not admissible. So penalty is not, as we understand in the normal parlance, penalty is what is defined by the court judgments and recognized by the CBDT in its circular. Now, then next is information regarding any payment made of any expenditure on which TDS was applicable and has not been deducted. That also is required to be stated. And as I said at the beginning, all this will depend upon the scope of work, the amount of volume, then the sampling, etc., for which the audit documentation and the specific accounting standards are there. Then in case of trading concern, this is important. And in case of manufacturing concern, in the case of trading concern, the particulars of opening stock, closing stock, sales during the previous year, in quantitative terms are required to be given. Now, all this is not required to be given for every item that is traded in. It is for principal items. Now, what is the definition of principal item is not defined in that. This is given by the guidance is given by the institute. Any item which constitutes 10% or more of the turnover is to be treated as a principal item. So, in case it is not given, then the concept of true and fair has to be examined by the tax auditor. Once that is examined, only then the true and fair view is feasible, and it is up to the auditor to take a call on that. And in the case of manufacturing concerns, apart from the similar detail, yield is also required to be given, shortage, etc., is also required to be given. For example, in the case of rice shellers or sugar mills, the yield of sugar from the sugar cane or from the rice bran has to be given. There is a wide difference between two organizations in the yield, between two areas, between two weathers, etc. So all this is required to be mentioned here, and that then finished product, byproducts, etc. Then clause number 37, whether any cost audit was conducted, and if yes, the give details. The tax auditor is required and expected to obtain a copy of cost audit report wherever cost audit is applicable and mention that. Then whether any audit was conducted under Central Excise Act, etc., that has also to be mentioned. Now, I am coming to the fag end because I find there are some certain questions. I would not like to burden the audience with one-way communication. So I think with the permission of the chair, I can start answering the questions if they permit.
Hello. Yes, sir. We can start to answer question-answer session.
Yeah. Now, I have noted down some questions. I would not be able to take the names because they were noted down by my assistant. Question is, do we need to keep a copy of the bank statement? Now, if a tax auditor starts keeping a copy of the bank statement, then probably it would be practically impossible because he may have, the assessee may have 10, 20, 30, 40 branches, different accounts. So what is required is maintenance of audit documentation in such a manner to state that wherever necessary, bank statements were referred to for the transactions, relevant transactions, and that who checked those transactions and what is the implication, if any, in the tax audit report of those transactions, that must be recorded. There is a separate guidance note on audit documentation also. So I think that should answer the question. Then next question is, educational society also leasing building for examination registered under 12A audit required or for
Tax audit is required or can be or both the things applicable.
then we get.
Or report in the
No, you see, the question is quite clear, and the answer is also mentioned in the Act itself. Act law. The Act starts with any organization engaged in business or profession, only then it is subject to 44 AB audit. The question says educational society also leasing building for examination. Now, if that is incidental to the object of education, I would take you to a landmark judgment of the Supreme Court in the case of Ahmedabad Urban Society and Noble Society. Both two judgments came last year. And in these judgments, the Supreme Court has held that any educational society, it is the case of Noble, it should be the sole object. If that is the sole object, only then it will be treated as a charitable organization. So the answer is that if it is treated as a charitable organization, then tax audit is not applicable. But if it is not treated as a charitable organization, the consequences are different. So the bottom line is that as long as it is a charitable organization, the answer cannot be on the basis of a question that is also leasing building for examination. If the sole aim is education and if all the income generated incidentally is deployed or plowed back for education and is nominal, is not more than 20%, then it could be treated as a charitable organization. Then next question is verify.
Clause 44, GST one clause. How to verify it?
Yes, this can be qualified. And last year, this is regarding the requirement of GST, which was made applicable very late after the closure of the last financial year, because till 21, it was made in arrears, it was deferred. The Institute and the Direct Tax Committee tried its level best to seek a clarification from the department, but till the last minute, no clarification came, and therefore the guidance was given by the Institute that it is applicable. So the software maintained by the assessees was not capable in most of the cases in giving the information required as per the clause 44. So therefore, qualification can be given. But as I said, the qualification has to be in the relevant para 3 and 5. Next question is calculation of turnover in case of an F&O business, also representation in ITR for where profit 6 to 7 lakh turnover is.
How to calculate F&O turnover and business turnover simultaneously. F&O में भी turnover है and business में भी tax audit के लिए कैसे क्लास करना है. And secondly कि मेरी turnover 2-3 करोड़ की है F&O में, but मेरा profit 6-7 lakh है. So how I have to show this matter?
देखो, I have understood the question as then I am replying. If the person who put the question is in the audience, they can clarify. Calculation of turnover in case of F&O, also in business. Now, as I have explained at the beginning, the turnover is to be computed for F&O on the basis of differences of losses and profits. Now, the next question is that the assessee is also in the business. Now, that has to be clubbed, the differences and business to come out with the turnover. The next is not clear. Also, representation in ITR where profit 6 to 7 lakh, turnover is 2 crore. I can't understand. If the person is available in the audience, they can clarify that, and then only I can answer, because the question is not clear. Then another question is audit documentation to be kept before tax audit.
Recording in
Vertical where
progress.
business is there, then it can be treated as a separate vertical, and then there it will be applicable as if it is a business. So both can be there. That is implicit in the clause that are there any profits of section 44 AD or 44 ADA. That is there. So it is not prohibited.
Mark to market loss.
Para 3C, 3 review. Auditor responsibility. One question is regarding auditor responsibility para in 3CA or 3CB. I think I have also answered that the auditor has to mention here the responsibility of the auditee, and also if any qualification is to be given or any difference of opinion between the auditor and auditee on any issues there, that has to be mentioned there. So this is as per the guidance note and very clearly mentioned.
Mark to market loss and the
How to work out and to be working.
mark to market.
How to show ITC on expense in clothing.
ये मतलब स्पेशल इन्वेंट्री कॉस्ट ऑडिट में साथ में एनहांस कर दिया है इन्वेंट्री वैल्यू. व्हाट इज द मैग्नीट्यूड ऑफ आउटकम?
A new provision was made to allow the income tax department to conduct inventory audit from a cost auditor on the lines of special audit. So that is post the tax audit. That is not at the time when tax audit was there. So as in the cases of normal tax audit, wherever special audit is conducted, so similar is the fate of this. So the auditor responsibility cannot be post-tax audit transactions. So this is as clear from the similarity between the special audit and the yet to come inventory audit.
Tax audit fees include the audit fee.
Fee approved by the board of the client company. If not, tax audit fee has been got approved by the. Not good question. Treatment of interest on balance in EPF account case of retired employee. It is not updated by the CA on the income tax portal for the respective tier filed by business. This is important question which is relevant for everybody. What if UDN not updated by the CA on the income tax portal for the respective tax audit report filed by him within the specified time? Now, since everything is online, digitized, if the UDN is not obtained or is of a date later than the specified date of 30th September, there is a grace period of 2 months already provided for such eventuality of incident of forgetfulness or lack of clarity when to take of UDN. So if it is not done within that grace period, then the UDN date will be treated as the date of tax audit. It is quite simple as that. Now, this question again cannot be answered. This question depends upon a particular product. I gave 2 examples. One example was of the rice shelter. where rice bran is separated and then the rice is shelled. The yield depends from crop to crop, the moisture, etc. Now that is a question of record. That is a question of production record. That has to be checked. Same is the case with sugarcane. The sugarcane which is grown in Maharashtra and sugarcane which is grown in UP, the yield is higher in Maharashtra, lower in Uttar Pradesh because of the weather, soil, etc. But that will come on the basis of the production record. That has to be checked by the auditor, whether he is a normal auditor or whether he is a tax auditor, and he has to perform his audit checks as to what. Now there is a case of a furnace, steel mill, rolling mill. Ignite is fired up to a temperature of 1000-degree heat. It melts, and then coil is made or other product is made, strip is made. So that is known as melting loss. So that is very little, maybe 0.5%, 1%. So all this is a matter of record. This we cannot give you a formula how to be computed. Tax audit applicability for trading in equity is 10 crores and 95 transactions are digital in nature. What is the document that client has to provide from stockbroker to account for purchases during the year? Now, this is again a simple audit. Now, everything is online, everything is recorded. The tax auditor has to obtain the contract notes which are there, on which the turnover is there, obtain the bank account, and from the bank account get the figure of purchase. So it is as simple as that. If the turnover is less than 50 lakh and income is less than 6-8% of the turnover, whether the tax audit under 44AB has to be carried out? Yes. The section is very clear that the profit on any turnover has to be 6 or 8%. I can further clarify, if there is a loss, then also the tax audit has to be conducted. Some questions I cannot answer because they are addressed to board, that the board can make a note and answer. One of the questions is, if I am panel on the tax audit quality review board, what is the procedure, etc. So somebody wants to become a assistant to the board. So what are the guidelines that the board only can answer? I cannot answer. I think most of the questions have been answered, and I have stuck to the time, because if I spend more time, people will get bored, and unnecessarily I don't want to drag them. With these remarks, I want to thank for the patient listening, all the listeners wherever they are, and I also give them the assurance that in case they still have any queries, they can mail to me, but I will answer after 2 weeks. I am going out of India for 2 weeks. And my team, if they are able to answer, they will answer to the best of their ability. And Good night and Jai Hind. And I thank the board and Chawla Saab and Chitale Saab and all the team.
Once again, thank you.
My pleasure, and I am available always. I can share with you the implementation, this study on compliances.
Yes, sir.
On tax audit report. I
Yes,
was
sir.
a contributory to that publication.
Yes, yes, sir.
Contributory to the guidance note committee constituted last year. So, to the best of my ability, I can answer whatever is available with me on the basis of guidance note. And I would also welcome few suggestions if there are. We can put across to the committee to further refine or give clarifications wherever the tax auditors are facing the difficulty. With these remarks, I again thank all the listeners and wish them best of health and luck. Thank you.
Thank you. Thank you.
Thank you.
Thank you very much, sir.
Welcome, madam.
Thank you very much.
I hope it was of use. I don't know.
Absolutely, sir. The number of questions which we have received and the number of participants really had a very fruitful discussion with you, sir.
Thank you.
Thank you, sir. Thank you.